Good morning, everyone, and welcome to week 2 of our Annuity 101 training series. Welcome back to those of you who joined us last week. We appreciate your attendance, and if you're new this week, that is fantastic too. You can catch up with last week's. I know Jason and Rebecca have sent out some materials to a few of you that missed last week to kind of catch you up, but we appreciate everything. I also want to take a second here just to thank everyone for the Q&A last week. That was fantastic. We get done with the content, and then I think that there's a lot of benefits to people asking questions, and of course we answer them the best we can. But if you hang on there till the end and all the Q&A is done, I think you can pick up a couple things even at that point. So I want to encourage everyone to do that again. If you have questions, to type them in, and then we'll get to them at the end of the presentation. So thank you for that. We'll continue on some small bites and that's what we really feel has been beneficial to many, is just kind of breaking this thing up and staying with some basics and not biting off too much at one time. So today we're going to cover about 4 things and topics, and when we get to those, we're going to cover types of accounts. We're going to cover 1035 exchanges. We're going to cover RMD basics. And then we're going to talk a little bit about surrender charges that come into effect on some of the annuities that we have. So with that said, let's go to the first slide here. So types of accounts, and we'll have a couple more slides specialized on this here in a minute, but just kind of lining these up side by side. This can be somewhat confusing sometimes, but we will help you through these. But the types of accounts that we're talking about is either a qualified account or a non-qualified account. And let me start by saying that none of us, well, maybe you are, but none of us in this office are tax experts. So we are never really give out any tax advice. We always phrase it with it's our understanding, but you always want to check with your tax person when you're talking to your client, that is. But anyway, the 2 columns, qualified and non-qualified. Qualified monies are any of the monies that are pre-tax basis. They're the contributions that are made that are not taxed at that time. So the second line there, accumulation value grows tax deferred, that's for sure. And what you would recognize as qualified monies might be in a simple IRA. The most common that you're going to come across are 401ks. So those are all monies that go into accounts wherever they're located, at the person's work or what have you, that have never been taxed before. So they have special tax treatment, and their taxes will come down the road a little bit, which we'll get into with RMDs. So the other major account would be non-qualified. So the taxes on these have already been paid on the principal. So this would be what you and I would know as maybe bank account money, might be in a mutual fund or some type of annuity or investment, but we have already paid the taxes on this principal. So it might be laying in a CD or a savings account, checking account, what have you. But with these, the interest still will grow on our annuities, tax deferred. You just kind of a bulletin there. If you look at the second column on non-qualified, if a person accesses those monies and not counting a SPIA, but in those monies in an annuity before age 59 and a half, then they can have a 10% penalty on some of that money. So just something to keep in mind. Obviously, everybody in our audience probably is dealing with the senior market like we are. Sometimes you'll come across somebody that is, say, 55, 56, no intention of using that money anyway before 59 and a half. But instead of their money being in a CD or savings account, they're looking for a little bit better return on their money. So we'll go to the next one. So drilling down just a little bit more, and kind of being repetitive here, I guess, but we deal, seems like a lot, in qualified monies. So again, let me reiterate that is money that has never, ever been taxed. Uncle Sam has not got their share yet. So the client is letting this money grow at a tax deferred rate. The second bulletin there, money in a qualified account can be moved from one investment vehicle to another investment vehicle without that being a taxable event. So I'll kind of stop right there a minute, and we'll get into the rollovers and exchanges. But we deal a lot, it seems like, of people that are retiring. So here in our town, there's Caterpillar, there's ADM, there's PPG, there's various manufacturing companies. But when that person retires from there, typically they have to do something with their money. They're no longer contributing to their 401k. Obviously, the employer's not, because they're retired. So they have to move it typically. So when you roll that money over to a fixed indexed annuity or a MYGA or whatever vehicle that we have, that is not a taxable event. Okay, so that's moving it from one vehicle to another. There's different ways, and I'm going to get in the weeds just slightly on this. But when that money is moved, so Jason over here has retired from ADM, and now he wants to get his money moved into a fixed indexed annuity where he's getting it out of the market and to some safety. We always encourage you to fill out the paperwork, obviously on the annuity. Let the insurance company notify where that money's being held, the rollover. But more times than not, it's going to take Jason, the retiree, to probably initiate that rollover, because they want to hear from that person that has the money, and they want to know that it's okay then to move it. So a lot of times in our process, we let the insurance company file the paperwork. It's received at the place where the source of the money is. And many, many times it's going to take maybe the agent to ask the client to go ahead and call them to make sure that they've got the paperwork and to go ahead and release that money. So that's very common on those. Sometimes, and again, I'm kind of getting in the weeds here a little bit, but bear with me. Sometimes the quickest avenue is for that entity where the money is. So whoever's managing in Jason's account there at ADM, let's just say, for them to make the check out to insurance company XYZ for the benefit of Jason Ferguson. That check would come to Jason. He in turn gives it to the insurance agent to get it to the insurance company. That happens more times than not, but it's cleanest if that entity that's holding the money just moves it directly to the insurance company. But I have seen it many, many times where they want the check to come to that person, to the Jason Ferguson, the retiree. But it's just, you want to make sure that they make it out to the insurance company, FBO, for the benefit of Jason Ferguson. So we can help you. We can hold your hand on that process. It's not probably as complicated as I'm stuttering around here. So it's pretty painless at that point. Okay. So kind of moving on to the non-qualified. Again, this is money where the taxes have already been paid. So Jason's accumulating this money and it's in his savings account, maybe put it in a CD, whatever it might be. But again, on bullet 2 there, non-qualified money can be moved from one investment vehicle to another at any time. Bullet 3, if the money's in a money market, savings account, CD. We found the best way to do this is for that client just to move that money into his checking account and then to write that check to insurance company XYZ to put that money into his non-qualified annuity, a MYGA, an FIA, whatever it might be at that time. That's the most common way of doing it on non-qualified money. There are some times where it can be directly transferred, for instance, and we'll kind of get into that on the 1035 here in a couple slides, where an insurance company will move it from one to another. But if we're talking about bank money where it's in a savings account, CD, whatever, I've always found that the cleanest way is just to get the client to move that into the checking, write the check, whether most of you are going to be doing an e-app, get it all in there. And then once the account number is established, a policy number, is to write it on the check, send it into the insurance company, and then go from there. Okay, so next category is our 1035 exchanges. So a 1035 exchange, we're going to have a nice sheet here at the end of this presentation to really help you with terminology and kind of how the process works. But in a 1035 exchange, let's just take the first one, non-qualified annuity to another non-qualified annuity. You can 100% do that. So it's insurance company A, maybe your annuity has matured. Now you're going to go with insurance company B because they have a little bit better rate. So we need to move the money from A to B. So again, we have filled out our EAP, the transfer paperwork. Company B sends it over to A saying, hey, Jason Ferguson is going to move his money over here. So that is a non-taxable event because it's a transfer of non-qualified money to non-qualified annuity money again here. So nothing is taxed on that. The second bullet there, some of you may or may not know, life insurance cash value can be moved to a annuity. So I can go from a life contract, pardon me, to a annuity. And that's happened many, many times. So you kind of wonder, well, why would they do that if they have a life insurance policy? And why would they move it to an annuity? There's many reasons why, but some of the most common would be maybe the beneficiary is now deceased. It's a spousal situation, maybe, that doesn't really need the life insurance. Those are income tax free, as we all know, but they want it to put it in a vehicle, an investment vehicle now. That is permissible because that money within that life contract is non-qualified money. So I can move that over to an annuity. I can move it over into a MYGA. So things change. Beneficiaries die in those situations, or let's just say that Jason, his beneficiaries were his kids, but they're adults now and they're doing just fine. I really don't need that life insurance for them. So now I'm going to go ahead and move it to a vehicle where I can get a little bit more growth on my money. So those are situations where that occur. Excuse me a second. So some no's. You cannot go from an annuity to a life insurance policy. So I've got just the opposite. I've got money in an annuity and I want to use it into a life insurance vehicle. I cannot do that. We have actually a couple carriers where there's a creative way to get that done, which we won't get into right now. But overall, typically, you cannot go from annuity to life. You can go from life to annuity. Also, a no-no is that I can't mix and match. And I should have mentioned that when we had it side by side, but I cannot mix and match qualified monies with non-qualified money. So if I've got some qualified money in an account and I've already got an existing that has non-qualified, I can't mix those. I cannot mix and match. Or if I have some money coming due, some of which was non-qualified, already been taxed, and then some of it is qualified money, I can't move those together into one vehicle. I cannot mix and match. And you'll hear us talk a lot about like for like, and we'll get to that here more too in just a second. But you always have to go like to like. And that, I'll just hit on it now. Like to like not only pertains to qualified and non-qualified monies, it also means the annuitant. It also means the owner of that account. So if Jason has a 401k, we can't put that into his wife's account. It cannot be transferred that way. We always have to move money like to like. That means ownership, annuitant, qualified to qualified, or non-qualified to qualified. So big terminology there, like to like. And of course, we're here to help you to make sure that all goes smoothly for you. Okay. The next term, third term of our floor here today are required minimum distributions. And you'll hear that mainly referred to as RMDs. This always has to do with the money that Uncle Sam has never got his share yet. Okay, so the qualified money. And this has kind of changed over time. Back in the old days, it was always 70.5 was the RMD age. So at age 70 and a half, if that money had not been taken out, I have to start taking distribution at age 70 and a half. Well, that's changed a little bit. So you can kind of see on our slide here, it's going to be age 73 now if you're, for those turning 72 in 2023 or later. Okay, so that would be age 73. We have many, many clients right now that were in the 70 and a half that have been taking their RMDs for quite some time now. But kind of in a nutshell here, you're looking at your bullet. Age 73 is going to be the RMD age now for those turning 72, or turn 72 in year 2023 or later. Then eventually it's going to increase to age 75 for anyone born in 1960 or later. So essentially RMDs are a way that get that money out of an account that has never had any taxes on it, that they are now making you take a little bit of that money out to where it can now be taxed. Hang on here, Jason. Let me stay on that just a little bit longer. I found the best way, if you're really curious about RMDs and kind of trying to figure that out, is to just, quite frankly, Google RMD calculator. So it'll tell you, even if you're not of age yet, there is some very creative ones out there that you can plug in what the account value is now. You can assess, say, a 4% growth, put the person's date of birth in there. So then it will project and kind of tell you what you're looking at for RMDs and what money is going to have to come out at that time. So again, those are, you want, and while I'm on this vehicle, and again, I will probably have some Q&A on this, but here's a pitfall. We will help you with this, but know that you need to know your client. For instance, if you have qualified money, so it's a 401k or whatever it is, it's money that's never been touched. There are some MYGAs that are not RMD friendly until you put a rider on there to make them RMD friendly. Because there are some MYGAs now, multi-year guarantee annuities, that are a la carte. So if you don't put any free withdrawal privileges on a la carte type MYGA, meaning that it's just staying in there and there's no free withdrawals on qualified money, and then it comes to RMD time, that does not work. So I've had that over the course of time that agents can make the mistake. We wouldn't catch that, just to be blunt with you. I'm always leery on a qualified count. If you don't have some free withdrawals, you better put some on there on the just in case. But we don't know that because a lot of times the cases are in there, we don't even see them. So just a heads up, if you're dealing with qualified money, make sure that you have a product that is RMD friendly. And some cases it won't, maybe they're going to not be of age even before this matures, no problem. But as a precaution, a safety net, just like most of our fixed indexed annuities are RMD friendly. And I know I'm kind of going along on this slide here, but some products are not RMD friendly in year one. So if that money is moving from an area and they're already in their RMD situation, so they're already been taking RMDs, you really want them, if they're moving that money, to take their RMD before they move that money for that year. So wherever it's coming from, you would call in there and say, hey, withhold the RMDs for this year, this coming year. It's done, and then you don't have to worry about that then when it moves to the next account. So we'll probably have some questions on that. Again, we're here to help you on that when you get to cases, but just something to keep an eye on. Okay. Our last area here are surrender charges. So just a couple examples up here. So a withdrawal or a surrender that exceeds the free withdrawal account, you can incur a surrender charge. So your client has a contract with the insurance carrier on this annuity. So the first one you're looking at would be a 2-year MYGA example. So typically if that person took out money that's not free, so maybe there's some free money like interest or whatever it might be, that's fine. But if it exceeds the free withdrawal, typical on a 2-year MIGA, then you're looking at it. If they took that money out that's not free in year one, you're looking at a 9% penalty. If it is incurring in year two on a 2-year MIGA, it's an 8% penalty. Now, the more common MIGA, multi-year guarantee annuity that's written, is a 5-year. So you're looking at the declining surrender charges there. 98765 is very common. So let's just move to year 3. And all of a sudden, extreme circumstance happens where that client comes to me and says, you know what, Kirk, I have to get out of this. I need all the money. I told you at the beginning that we weren't going to need it, but something has happened in our family now, and I really need to get at all that money. So whatever that account value is, minus anything that was free withdrawal, they're going to pay a 7% penalty to get all that money out because they broke the contract. This rarely ever occurs, but you just want to make sure your client knows that there are circumstances that if they need to get at money that's not free, that they're going to pay some surrender charges within that. So it just happened this week, in fact, that a person needed to go in and grab $10,000 because of a family emergency. Okay, so there was some free in that, but the 10,000 was excess of not free. So whatever year they were in on that particular annuity, let's just say they were in year 4, they're going to pay 6% penalty on that $10,000. So not the whole account, but just the money that they've taken out that they're going to pay that surrender on. Okay, so those 2 lines right there would be kind of a typical MIGA surrender chart, if you will. So this next one, and it's branded by one of our carriers there, but so this would be an example of a FIA, fixed indexed annuity. And you can see in the yellow there, so that first column is a 7-year. This is pretty typical. You're looking at a 7-year, a 10-year, a 14-year. So yeah, where Jason's arrows are there, you can kind of see the surrender costs as you go here. On the 7-year, it's 12 in the first year, a 12 on the second year, 11, 10, 9, 7, 4. But just to be aware, so a lot of the fixed index are longer terms. So you're looking at the screen there, 7, 10, and 14. But a lot of those too will maybe have better free withdrawal options. So some of them have income riders that are free. Some of them have built-in RMDs, that is free. But know if their client breaks that contract, that there are surrender costs involved, just like there were with the MIGA. So each company is a little different. Each product is a little bit different, but it's just something to be aware of when you're writing annuities that, if they break a contract with the insurance company, there are going to be some surrender costs in that situation. Okay. Just about done here, Jason. This is a sheet, and I think we'll provide this for you, I'm guessing, right, Jason? Yeah. Go ahead.
Yeah, we'll send this out in a follow-up email, and I'm also pasting a link in the chat right now.
Okay, so this will help you a little bit in terminology, kind of, where the funds are when you're filling out apps, and what do I mark as to where the money's going. So I'm not going to go through it. It looks a little bit busy maybe at first glance here, but I actually have this chart up in my office just to always look at it. But it will help you when you're completing an application of where the money is originating from, where the money's going to. So just something that we provide. And Jason and Rebecca, they come up with a lot of clever little, I don't want to call them cheat sheets, but really helpful one-pagers, if you will, that will educate you, that will help you a lot when completing an application. So this just is one handout of many that we have and that you will have access to when you contract with us with some of our carriers. So we'll cover that. And with that, don't know what we did on time, but any Q&A here, Jason?
Yeah, we
field
got a few.
Okay.
Okay, so Anne asks, I got slightly confused. Did you say to get a check for the benefit of, or that the client must call the new company to move the money, or both?
Yeah, and I made that clear as mud. I'm sorry on that one. But what I have experienced on a lot of cases when that qualified money, okay, so this really happens on the qualified accounts. When that person retires, there are some of the people that have been managing the money. So, and I said ADM, that's a huge uh, company here in Decatur. A lot of times they want that money to go to the client. Well, we don't want that check made out to the client. It gets a little bit messy. They have 60 days to get it into a new account without it being taxed, but we don't even want to go there. So what we'll ask is that source at ADM to go ahead and make that check out to company XYZ for the benefit of, and they'll just put FBO of the client's name. They want to mail that check to your client. So as soon as your client gets that check, I've had personal experience with this, so I know 100% this happens quite often. That client will then get me the check as the agent, and then I'm going to overnight it, track it wherever it has to go to that insurance company. Ideally, we want where the money's originating from, we want it sent directly to the insurance company, made out to the insurance company, no FBO, just made out to insurance company XYZ, and they just move the money direct. That happens quite often as well, but you're going to find out that sometimes they want that money. They want to know that the client put their hands on the money. So that's when the FBO for benefit of, but again, always make it out to the insurance company, that check.
Okay, Andre, are most FIAs RMD friendly?
Short answer would be yes. There's going to be some exceptions, but to further that, that's a great question, Andre, but to further that, some of them are RMD friendly in year one. So I can get that money. If I did not pull my RMD out from where the money came from, some of them are friendly in the first year, but some of these products are not friendly to RMD until year two. So in other words, that is where you got to make sure that they pull their RMD out before the money's moved. Personally, I've done these myself. I like for them to take the money out before it's moved. It's a little bit stickier, but they'll do it. The existing carrier or entity will do that for the client for sure. Because sometimes when that money is pulled out in year one, you're going to look at a chargeback because they're going to take it off of what is deposited because that's money that came off. So if 150,000 came over, and then they're going to pull back 8,000 off of that for an RMD, there's an 8,000 money that I'm going to get charged back on my commission. So as an agent and for the cleanliness of it for the client, I always encourage them to take the RMD out ahead of time. But short answer, most of the FIAs that we deal with are RMD friendly. It's just a matter of when.
Okay, we have another Kirk that asked, I missed last week. Could you please send the info to me? I think he's meaning the recordings. So Kirk, yes, that'll be in the email that we follow up with. And also I'm pasting in a link to our website. We have a page. You do have to be signed into the website, but we have all our previous recordings. And Joy, if they started taking RMDs and the age is increased, does that apply to them and can they stop taking RMDs? And this was in reference to if they started at 70 and a half and they changed the age.
Yeah. Now, once they started RMDs, they're in, and there's no stopping RMDs, not without penalty. So no, once the RMDs start, they are in. So there was transition on our laws of how the age actually is increasing, as you saw. But no, once they have started RMDs, it's not stopping. It's and most of the accounts that we have, quite frankly, right now, that was under the old laws, rules of 70 and a half. But you're going to start seeing more and more where that changes based on your client's age, but it can never stop. And I'm probably say it again here, get on an RMD calculator and it gives you a good idea. Do it for your own self of, if I'm 63, so I can punch in, that you've got X amount of dollars. I'm going to project 4% return, and then my RMD is going to be at age 75 because I was born in 1961. So it'll kind of tell me my chart of what I'm kind of looking at of what my RMD would be at that point.
Okay, Greg asks, are surrender charges the major impetus for suitability?
Yeah, because they want on suitability, and we have some nice guides. Every carrier has their framework of suitability, but I can tell you they're all about the same. Suitability is the underwriting. That's the protection for our clients. They want to make sure they have enough liquid. They have enough to live on for an emergency, for paying their bills. So, well, we do have some carriers where you can say that they don't want to do the suitability. It's not very often, but we do have some that have that. Most do not do that. And the suitability, the surrender fees are there because, I want to make sure as a company that we're not putting that client in a vehicle to where, gee whiz, they don't have enough money in their savings account or checking account or money that they can touch in case something happens. So that's where those come into play for sure.
Okay, Jason asks, does SILAC offer other products in Texas?
SILAC has an array of products. This person can email me and I can send you their product grid. So they have a portfolio that is obviously for every state, all 50 states, of what is approved and what's not approved. But I can tell you it's vast. And I don't know off the top of my head if anything in Texas would not be approved. Sometimes when you get into FIAs, they may approve the 7-year and the 10-year, but not the 14-year. So there's some states where that's very it's prevalent in some states where they don't let them have the lengthier FIAs. So get with me on that if you would like, and I can sure email that to you for sure.
Okay, Justin, what about rolling a non-spousal inherited annuity into a new annuity?
Yeah, so I think you're probably talking about inherited IRAs. So those, not every carrier takes those. We have a couple carriers that are inherited IRA friendly. And then there are some rules about distribution on those. It's to be a little bit complex, but we can help you with that. There are a couple carriers, our favorite carriers, I guess I should say, that are now going to move to where they will accept inherited IRAs. But with that said, we have plenty of carriers that will take those, and we can help you with how the distribution looks on that too as well. So,
okay,
great question.
Crystal asks, I have a client that received a 1099 for the surrender charge for an annuity transfer with no taxes taken out, even though we added to the app to take out taxes. What can we do in this situation?
You better give me a call on that if you don't mind, because there's always probably more to this story, and I would probably have a lot of questions on that. So honestly, I'm not going to be able to answer that greatly right now in this kind of a format, but give me a shout. Give me a shout on our 888 number there you see on the screen, and let's talk it out and I'll help you.
Okay, Ann, if someone did not do an RMD in a timely manner, is there a government penalty?
Short answer would be yes. And again, now we're kind of getting into the tax framework, so that person would want to get to their accountant and figure that out. But it would be my understanding, that's what we're taught to say, it would be my understanding that yes, there would be a penalty. They do have some forgiveness. I know, I've understood that there is some grace periods that can be implemented, but that is 100% a tax person's question.
Okay, Dale, general rules with 403B transfers.
Yeah, Dale, we'll get together on that one. There's some trickiness on that. There's some companies that won't take that. So we'll have to talk that out. I know who Dale is, so we'll have to talk that out.
Okay. Greg asks, why does the government even make people take RMDs?
Well, Greg, because they want their money. So money that has never ever been taxed. At some point, the government, Uncle Sam, they want to get that money back in our system. So they have to get it taxed. Just like, okay, so if I have an account that's a retirement account that's never been taxed and kind of almost goes with the inherited IRA, that money's, and I die, that money still has to get back in the system. If it, let's say my wife was deceased, and so it's going to my kids, there's going to be typically a 10-year period where they have to get that money out and it has to be taxed. So that's just the way it is.
Okay, Darren, if your client has a lifetime income rider and they turn the income on, do those payments count toward RMDs?
They can, yeah, they for sure can. So qualified money, obviously it's got to be qualified money. That's, you have a fixed indexed annuity that you have an income rider on and it's activated. More times than not, what has been our experience, what I see is the lifetime income rider, that money, that amount exceeds what their RMD requirement is. You have to make sure that it's that, but everyone that I have ever seen, to my knowledge, has always exceeded that required RMD amount. So you're in good shape there, typically. But it's something that you gotta pay attention to as well. Usually the product is built like that, though.
Okay, Russ asks, can you address the direct beneficiary recommendations for trust-owned annuities and the need to 1035 exchange to avoid immediate tax on all gain?
Ooh, that's a tough one there. So we have had some experience on annuities that are owned by a trust. There still has to be a living annuitant, a living person that is the annuitant. The beneficiaries of those obviously is typically the trust. If the owner's a trust, typically the beneficiaries of trust. Those can get into some really muddy waters, honestly, of tax situations and non-tax situations. But a trust can't be the annuitant. They can be the owner. There always has to be a living person in that. So typically it's the grantor or the trustee or whoever it might be, but those have to have a person as the annuitant. So it gets a little bit murky on the taxation of that. So I feel like I'm really not answering a lot of questions, and I can't answer tax questions typically anyway, but maybe you want to give me a call on that if you have a particular case. It's not uncommon that we have this come through here, but a lot of times that's finding the right company and product within that we can hold your hand on that one if you have a particular case.
Okay.
That it? I don't know if I did a very good job, folks, on the Q&A today. I have they were great questions, and some of them are going to be phone calls that we really talk about specifics of, but I appreciate all the questions. And I know I said it last week and it's corny as it can be, but it's worked out pretty well for us here and it won't change for me on my behalf. We are here to help you, help as many people as you can. I know it's repetitive, corny, whatever you want to say, but we want to make sure that we're doing the right thing always. That's what we're here for. There are some safety nets with carriers, but sometimes they're not. But that's what we want to always build a relationship with you. We want you to feel comfortable. We do a pretty good volume here, but we're also relationship built. Okay. So we want to make sure that we're individualized with you. And that's what I'm here for. I fielded a lot of calls last week from when we ended that webinar to this week. I try to get to everybody that I can, whether it's an email or a phone call. I want to help you. I mean, we of course want to earn your business, earn your trust, all of that. But the bottom line is we want to make you comfortable with helping some of your clients in the money. And, if you watch the market at all the last few days, it's pretty turbulent. So, some of our products can really steady that for people, and particularly the ones that can't endure major losses at this point for the recovery time. You know, the market's always going to be fine at the end of the day. It's just when is it going to be fine, and can your client wait that long to, so that's where we can come in as insurance carriers and insurance agents, is to give them safety, some guarantees, some peace of mind. So anyway, hope I give you peace of mind, but feel free to give me a call, reach out to me, email, whatever it may be, and hope you tune in again next week on next Wednesday at 10 a.m. Thank you all.